Fantastic. Don't expect very sexy looking slides. I rather focus on quality of content rather than sexiness. But when I was thinking about iBuyers, I thought, there's a lot of information that's thrown out there very quickly. A lot of newspaper headlines that are popping up everywhere about them. And I thought, well, we should have a chat about it, right? Do a bit of analysis and have a bit of a deep dive into a couple of things. And these are some of the headlines that you're seeing up there. Zillow wages on flipping houses with iBuying. Open Door raises $300 million on a $3.8 billion valuation. Zap in Brazil investing $25 million to 200 properties in the Brazilian market. You've got the latest company to receive a valuation of $1 billion is Loft in Brazil. They're called a unicorn down there, $1 billion market. Codit.io and Ribbon. It just, doesn't matter where you look. The concept of iBuyers and the noise around it is everywhere. And so naturally the question that goes through my mind and everyone else is this like the future? Or is it a fad? Very bluntly, I think about it in those ways. So I thought, why not put on my ex-management consulting hat and go for a deep dive and try to do some analytics around this and to see where you come to. And then I've broken this really into three parts. The first part is looking at, well, how's the market viewing this? In terms of valuations and capital raised and so on. Then I thought, well, we better have a look at the model. What is an iBuyer? And then I thought, well, let's do a deep dive on Zillow, who wants to tell you everything about their business and what's the impact been. And then out of that, hopefully draw a conclusion about where I sort of view it today. Is it sort of this future or a fad? So iBuyers are everywhere, and Malcolm sort of put his slide up there earlier today, and I did this totally different view, sitting in a cafe in New York a couple of days ago. So clearly we're thinking along the same ways. And honestly, the US is full of these characters. Everything from Knock to Open Door to Zillow to OfferPad, Ribbon, Homeward, Redfin Now, Orchard, ... There's a bunch of them out there. European markets, same thing. Godito, Nested, and we can debate about the exact model, but there's models as Kosovo, HomeLoot, Tico, Pronto Piso. We can debate about iBuyer or not. It's just a debate. Imo, and so on. There's a bunch of them. Then, of course, not to be left out, we've got Brazil with Loft and Grupo Zap, and then the other one, Open Casa, you talked about earlier today, which I didn't have up there, and Saleable in the Australian market. So it's happening everywhere, the whole concept of the iBuyer model. And of course, they're raising significant equity, bunch of money. There's here if we have Open Door. Now it's interesting when they're founded. So the whole concept really started to get going with Open Door in 2014, right through to new players, Loft in 2018, Ribbon in 2017, and so on. Okay, I haven't put Zillow on there because they're listed and they're raising capital through a different vehicle. But just in the US alone, that's $2.2 billion in equity raised. Okay, and of course, they're not just funding these businesses on an equity model. They've got debt funding involved as well. So just across 5 of them, you're looking at $5.4 billion in debt financing raised. Most of it in the last couple of years, right? Probably in the last 12 months, to be honest. Because the market loves this stuff. They are absolutely getting into it. And here are some of the people who are backing these companies. General Atlantic, SoftBank, Goldman Sachs, Citibank, Anderson Horowitz, Vulcan Capital, Fifth Wall, doesn't matter, right? It's the flavor of the month. It's where the money is going. It's what's driving the valuation of many of these companies because they're falling in love with this iBuyer concept and what value it potentially can unleash in the future. And of course, the equity markets love it. Zillow's a great example. Zillow was trotting along back in the 10th of October, had a market cap of $5.9 billion. Okay? It then started to release results for the Q3, which would have been in October. So it's not us, but probably just after the 10th here. And then clearly Q4, which has been recently. And this is sort of what's happened. It's put on $7.5 billion or 125% growth in its market cap in literally 5 months. Okay? If that's not a market falling in love with what could be, I've never seen it. Okay? But that's literally the growth in the share price. And you see that absolute skyrocket at the end there is because the results were released last week, which talked about the growth, basically the whole growth of their business has been driven by now the iBuyer concept. We'll do a deep dive on Zillow in a little bit, and I'll give you my thoughts on whether it's a fad or the future. Okay? But that's quite amazing. I wish I'd bought some Zillow shares on the 9th of November, and I would have exited last week. Okay? Now, there's significant businesses being built here as well. You know, there's 1,500 employees roughly at Open Door. Zillow's got 1,000 focused on the offers business, you know, right through to OfferPad and Loft. I mean, there's a big businesses that are being built. So it's not just raising of the money to go buy properties, but you've got to build the infrastructure around to make this happen. It's not a walk in the park. Okay? And they're starting to have an impact on sales. And as Malcolm talked about before, you know, this is just properties purchased for the first 9 months of last year. We're talking about, 25,000 properties in the first 9 months. By the way, you can all get a copy of this presentation if you want to keep taking pictures. I don't mind. But I'm going to very happily give you a copy of all this stuff. All this information is just market sourced. There's no proprietary stuff in here, and I'm very happy to share it. So 25,000 properties in the first 9 months, then you bolt on to what they did in the last quarter in terms of purchasing, and you're probably up to, 35,000 properties out of 6 million. So really it's just a drop in the ocean into what could be. Okay. Now, what are the types of business models? There's really sort of two business models, this is in my opinion, that fit under the category of iBuyers. There's the sort of the informed flipper, which I'm going to call it, house flipping, buying, holding, renovating, selling. And then there's the bridging loan provider, okay? Because they sometimes end up with owning the property. So we'll talk about each of these two models in turn. So the informed flipper, it's about buying your current home, holding it, improving it, and then selling it. Okay? And we're seeing people, Open Door, OfferPad, Zillow, Redfin now, Orchard. Now, I've just looked at the US for this, otherwise I'd be writing for many, many more days, and it's just going to be more logos shoved up on a screen. So the US is a good place to look because it's an indicator of what people are aspiring to do in other markets. Whether they're going to be successful or not is another question. So what's it really look like from a process perspective? So this is my management consulting coming out of me. The homeowner requests an offer online. Okay? It's a very simple form. You fill it out. It's driven basically by honesty. It's going to be verified later, of course. And based out of that, the iBuyer will assess the value. That's driven by an AVM model. There's approximately an offer rate. So the acceptance rate to offers of requests would be around 2 to 3%. So it's not a lot. So 2 to 3 out of every 100 people wanting a request get an offer. Okay? The sweet spot seems to be in this $150,000 to $500,000 range. It's a market, especially in the US, that is, as Malcolm alluded to before, is very sort of programmatic. You can see what the properties look like, they can be highly analysed, and you can get a pretty good indication of the value. The offers are usually very close to the valuation range, around 99%, more or less, right? Basically, they're offering you the money. But there's no such thing as a free lunch. There is a service fee attached to doing this, okay? And that service fee is in between 6 and 10%, depending on who is providing. So at the end of the day, you don't receive the exact amount you asked for. So here, this is an example of Zillow. The market price is the offer price is $260,000. The estimated cash proceeds are $236,000. That's 8.9% fee. Traditional agent charges 6%. So there's other money going to them. And that's basically they're building into the model their fees for how long I've got to hold it for, the renovations I'll probably have to do on the property before I then resell it. Okay? So while the offer price is the market price, in reality what you receive is more or less what you would have received anyway. If the home offer is accepted, if the the seller accepts the offer, property's got to be inspected, because then they have the chance to adjust the offer based on the state of the property. The iBuyer, or sometimes the seller, depends on who you're dealing with, because they've got different versions of the model, will do repairs. Sometimes the iBuyer does it, sometimes the seller has to do it before the iBuyer will take possession of it. And it's up to 3% of the value of the property. They'll say things have got to be repaired. What they're doing is making sure they can resell the property in the future. The closing is usually based on what the seller wants time-wise, when they need the funds. But it's usually in that 10 to 60 day window. And then, of course, the iBuyer wants to sell the property using traditional marketing channels, using their own sites, often with incentives because they don't want to hold all these properties for a long period of time. So there's incentives, maybe a rebate, maybe a refrigerator, who knows what it is if you buy the property. And they're targeting less than 90 days of holding the property. That's the model that they're trying to put in place. That's the informed flipper. Okay, here's what other guys are doing in terms of fees that they're charging. So you've got Opendoor, Zillow, OfferPad, etc. They're all charging in that range of, Opendoor's 6 to 14% they're charging. Clearly it's going to depend on the state of the property, where the property is, how hard they believe it is going to be to resell the property, the works required, the extended time that they may have to hold on to the property, and so on. The worse it is for Opendoor, the worse it's going to be for the seller. But that's probably a reflection of what's happening in the market anyway, because you probably aren't going to sell the property as quickly as you would like if you go through traditional means. So they're all pretty much in that range of somewhere between 6 and 10 to 12%. Okay? And of course, then you have people like Orchard to come in and say, you know what, it's 6% flat. So you're now starting to see competition between the players, which as you'll see is already a challenging model as it is, around the fees they charge. And of course, what are the revenue streams that the iBuyer recognises? Well, they clearly recognise the sale price on the property, which is why you see the Zillow revenues going through the roof, right? You buy a house for $250,000, a house worth $300,000, you're buying it for $270,000, and you're going to resell it for $300,000, okay? Once you've done some work and whatever. You get to recognise the $300,000 as revenue. And as Patrick, I think, was alluding to before, you probably want to think about the net rather than the gross as a real indicator of the value. And of course, they want to bolt on mortgages, bolt on relocation services, and for people like Zillow, for those 97% of requests that have been knocked back or an offer not made by Zillow, they become leads that can go to their network, that they can then sell to their network. So it's also a lead generation tool inside the Zillow business. So let's look at the next one, the bridging loan provider. They have a slightly different model. They're about buying or funding your future home. They'll then market your current home, and then they'll sell and transfer across and take the net proceeds. Okay? Of course, if they don't sell it within a period of time, many of them accept to actually buy the property and own the property. And that's people like Knock, Ribbon, Homewood, and Orchard does both models. So let's look a bit more about what it means. So the homeowner, in general, identifies a new home, or they could ask for an assessment on their current home. Either way is where the starting point is, and it can be any home on the market. The iBuyer doesn't care who it is, as long as it's a home that someone needs to have funded. So what they're really doing is solving the problem is, I want to sell my house, I want to move to another place, and I don't want to wait until I've sold this current house to get the funds to move. They're allowing me to move today, and they're funding that bridging period. Okay? The iBuyer will then assess the current property, because they've got to really understand what the value is there, because they may end up having to buy the property. Okay? They're going to value, so they have to do two things. They value the property you're going to buy and the property that you're selling. Okay? And then they put together a complete package for you. If the homeowner accepts, the iBuyer then acts as the buyer's agent to find the new home, so they're going to get their 2 or 3% commission on that transaction. And then the iBuyer will start to market the current home, so they act as the selling agent. The iBuyer will then, on behalf of you, make a cash offer to take title of the new home. And because it's a cash offer with no financing, they usually get about 5% less than the market rate. Okay? And then of course, the iBuyer takes possession of that new home. The homeowner then moves into the new home, rents it out from the iBuyer, while the iBuyer is then selling the current home that's still owned by the person who's moved. Okay? And you can rent from, depending on the iBuyer, from 3 to 12 months. And they charge you fair market rent, and of course all the additional costs associated with the iBuyer holding the new property for that period of time. The iBuyer currently markets your current property, pays for any repairs, which of course are recovered out of the sale price. Then if it's not sold by a certain time, then some iBuyers offer a guaranteed sale. Because the issue is, if you don't sell it, you may have to move out of your new home and back in to your old home because the iBuyer actually owns your new home, right? Okay, and then they obviously charge the standard 6% commission in that process. And then ownership transfers, and there's settlement, and the settlement really then balances it all up. So you've sold your old house, less the fees that the iBuyer has charged for selling it, less the cost of renting the property, less any other fees, etc. And that's what's transferred to you to then refund the iBuyer for the property they bought. Make sense? It's a different model. It's a funding model. And this model, the Knox of the world have raised money to finance, and they don't end up owning the property. Okay? Or if they're owning the property, they're owning the property for a short period of time because it's the new property. But they've very much got it offset against the old property, and they've done the analysis. So it's a safer model in many respects. Okay? Then clearly, what do they get to recognise as revenue? Well, there's clearly sales commission because they're now acting as a sales agent. They get the buyer's agent fees. Of course, they get to recognise when they act as the buyer's agent. And then there's mortgages, relocation services, and of course, cost recovery of rent and the other costs they've had for that short-term rental. Now, there are two ways in which happening. There's Knock and Orchard are doing that model, right? They're charging 6% commission on the sale of the old property. Ribbon and Homewood are very much about purchasing the new property. So they fund the purchase of the new property. They charge you a 2 to 3% convenience fee for doing it, but you're responsible for selling your old property. They're not getting into that game, and therefore they don't run the risks of ending up owning the property at the end of the day. So those bottom two are really financing options, okay, under the guise of an iBuyer, and the top two are more like iBuyer models because they do end up owning property if they can't sell it within the period of time. So that gives you an idea of the two different models. Now I thought we'll do a bit of a deep dive on Zillow, because it's always fun to have a look at what someone who has got incredibly high valuations and losing a lot of money is actually doing. So they're delivering strong growth in revenue. Okay, we all know about that, while delivering incredible increases in losses. Okay, so two things go quite harmoniously together. Okay, so as you can see here, they're now up to 2.75 billion in revenue for 2019. On about 300 million plus losses. Surprisingly enough, in 2012, they actually did make a bit of money. Okay. Now, where's the growth coming? Well, it's all coming, as was mentioned earlier, out of the iBuyer business. 93% of the year-on-year revenue growth was from that business, because only 6% annual growth is coming out of their internet, media and technology business or their traditional business, because they've realised that that's a hard business to go. Would you call it a 2.0 business? Probably, more or less. And they've said, look, we're basically they've said the big bet is on iBuyer. And they're very good at promoting it. They're very good at getting the market super excited about it. Okay? And creating shareholder value. But it's all built on the iBuyer model. So then you start to say, well, okay, well, what's happening here? So let's deep dive on the Zillow offer business. So this is just their offer business unit. So here we were talking about, so it's basically what's behind, let me work at this one. Here we go, just this grey bar there. Very annoying this, okay? So, good growth in segment incomes. And what we've done here is I've broken out their expenses into the cost of homes sold, and then we'll see, importantly, this is their overhead bucket, which is about 75 million. Overhead, the cost of the teams, the locations, operating in 75 markets, and so on. And there's a bit of other bits and pieces that are in their costs, but they're usually non-cash related stuff, things like share option plans and so on. Okay, and that's why, and this is quarterly numbers, because I love them for they give out lots of quarterly numbers. Here in 2019, in the last 3 months alone, they've lost 107 million as they're growing their business. So they're very much investing for the future and focusing on revenue growth in the hope that they can reach some sort of scale and then move into profitability. Now, they're operating in 25 different markets across the US, and they're opening more soon, is what you sort of expect. Okay, now there's clearly a natural lag between buying and selling homes. So what we see here is the growth in the homes purchased. Clearly there was a dip around Christmas and moving into the pre-Christmas period, which is not surprising. This is the home sales, and here you've got the inventory they're currently carrying. So they're carrying 2,700 properties worth, what's that? Basically just under $1 billion of value on their books. Okay? And you clearly don't want to carry that for a very long period of time, because it's one of these businesses where you've got to have good churn of your stock. Now, this is quite important because it then lays the foundations for everything else. This is how they view the economics around a business. And focus in the green box, okay? Their average revenue per home sold is $317,000. That's what they recognise. Every time they sell a home, that $317,000 gets put in the bank and recognises revenue. But there's home acquisition costs. So remember, I made an offer for around about $317,000, less than 9%, because I took out my fees. So that's the cost they've got to recognise. There's renovation costs of $14,000. There's holding costs. Now, holding here are mowing of lawns to anything else that's related to holding stock, because you've got to have maintenance, etc., which is not renovation, it's maintenance. Okay? And there's selling costs, and they're the costs related to selling the property at the end, because you probably have to pay someone. If you're going to sell it on your site, you're probably going to then pay someone, the buyer's agent fee, or you might even have the selling agent fee around it. And then, of course, they've got interest expense attached to that property, because that's the cost of the interest related to holding it for the period of time from owning to selling. So they're losing, at the moment, $6,407 on every property that they're buying and reselling. That's the gross profit, or in this case, gross loss, per property sold. Important. Makes sense for everyone? Simple? So then the next question is, well, how's that 6,407 been trending? The answer is the wrong direction. Okay? You look at every quarter, 3,200, 3,000, 4,800, 6,400. And you can say, well, why is that, right? Is it driven because maybe the margin between buying and selling is shrinking? Is it driven by something else? Let's deep dive again, right? The more you dive, the more you start to understand the fundamental challenges in the model, which is what this is all about. So what they're attempting to do is to say, how do I get to a point, this is where they are at the moment, right? They think they're probably getting, this is return before interest, and then if you add interest into it, they are currently losing about 2% on every property. That's the 6,000, 3,000 purchase price, or 3,000 revenue, and they lose 6,000, that's 2%. Okay? They think they can get their operating costs down to 95 to 96% to make a 4 to 5% margin, add in the interest, because it's a better way to think about it, and they want to do a range of 97 to 98% of the operating costs, so which means they're making around 2 to 3% margin on every home they sold. Okay? And out of that, you've then got to cover operating costs. So you can pretty clearly understand that this is a game of massive scale that they're chasing. Does that all make sense? So that's their aspiration. So how are they going? So here is the quarterly operating costs, including interest, as a percentage of the sale price. And that's the target. So they're targeting, remember we talked about they're targeting somewhere between 97 to 98%. So they would have the inherent 2% profit. But they're moving in the wrong direction. Right? 100%, they've basically gone from just over 1% above the sale price was the total cost, and now it's 2% above the sale price. They've got a gap of 4 to 5 percentage points they've got to somehow shrink to get to the point where they are covering the operating costs of the business at scale. Slightly challenging. So then you have to go, well, why is that line moving? Is it because I'm acquiring properties at less of a discount to what I'm selling them? But it's actually going the other direction. So if you take the sale price, so in that case was the $307,000, in Q1 they were acquiring them, so the offer price less their service fee was 90.8%, right? Now it's down to 90.2%. So they're basically acquiring 10% profit margin in there. So then that's going in the right direction. Good. If that can go down to, if you're running this business, you get that to 89, 88, 87, you've got more of a buffer. So it's heading in the right direction. So if they can continue to acquire properties cheaper, they can hopefully close that gap. The challenge with that is you've got all these other players in the market. And they're going to start to want to compete for the same types of properties. Because if I'm an iBuyer, or someone who wants to sell to an iBuyer, I'm not just asking Zillow and no one else. I'm going to ask Zillow and OfferPad and Open Door, and they're all going to come back with hopefully similar offers. And then it's going to come down to what's the service fee. So what's the natural point of competition? The service fee, which will then have the impact of pushing that number back up again, right? Because you're basically giving away margin. Okay? Slight problem. So then I looked at the other costs as a percentage of the sale price. This top line here, the grey one, is the cost of selling, and it's basically flat at around 4.2, 4.4%, which is sort of logical, right? Because if you're selling it, because you own it, you're going to always keep the 3% because you own the property, right? So all you're now worrying about is paying maybe so you can always pay 3% to a buyer's agent, and you may pay some to a seller's agent. So therefore you're around that 4%. That's flat. The cost of holding is pretty much flat. The cost of the interest is pretty much flat. The cost of holding's moved up a little bit. But here's the issue. Look at renovation. From 3.6% of the price to 4.7% of the price. It's going up. Don't know why. I haven't got to the bottom of that one yet. It's probably because either they're buying properties that need more work, or there's more competition for doing the work. And therefore they've got to pay higher prices to get the work done in the time frames they've set themselves, which is that 90-day period. So far the underlying trends aren't looking great for the business. And of course, then you've got to think about the overhead of running the business. So I've calculated what I think is the overhead here, because they clearly don't disclose it, clearly. But I've done the best at calculating it. And what we see here, this is in US millions per quarter. The cost of running the business is getting more and more expensive. This doesn't include anything to do with the property. This is the cost of running the business. It's now $75 million a quarter to run the business. Remember, they've got 1,000 employees. That's getting bigger. So then the natural thing to do is saying, well, wait a second. If I can improve my margin from -2, so the currently sits at -2%. If I can get 1% margin, just holding still the average home price and the average overhead costs of Q4, I'd have to sell 23,500 properties to break even. I'm currently selling 2,000. It's a bit of a gap to close. And I doubt I'll be able to sell 10 times the amount without increasing my operating costs. It's just not logical. If I can get the 2%, remember they're targeting that 2 to 3% with interest taking range. I've still got to sell somewhere around between 7 and 11,000 properties. It's still 4 to 6 times what I'm currently doing, assuming no change in the price of the properties and no change in the overhead costs, which are clearly going to go up. Suffice to say, this doesn't look like a rosy picture to anyone. And economically, it makes you question why people are doing this. So when I think about, I'm going to call the jury still out, right? Because if I'm an equity investor and I invested in October, I'm very happy, right? And we've always got to think about this in two forms. What is the underlying equity story and where the value is? And what is the underlying business? And the two aren't always connected. You can have very good businesses making great profits and the market hates them. And you can have businesses with weird financials, not profitable, and no sight of being profitable, being valued very highly. Okay? Which I gather, this sort of fits in that category. So the pros are there's new revenue streams that can leverage the core business skills of Zillow in this example, or anyone. Okay? You can create liquidity in the market. You're creating liquidity. You're getting housing moving around. Potential to capture larger revenues at scale, right? Because you've changed the way in which revenue is recognized. And you can able to sell adjacencies, which is what they're banking on partly, because I'm sure if we could actually get into their numbers to find out the adjacency revenue, you'd have a different story. Okay? And the equity markets love the upside potential. However, the con around all this is inventory has carrying costs. There's a poor predictive model, right? If you have a poor model or the model doesn't get it right, you have a problem. There's a potential downturn in the market. There's competitive pressures which can attack these slim margins, so there's no room for error. And what's scale going to be like? A lot bigger than it is today. And these large businesses have many, many moving parts, and it's going to be super difficult on management to keep them all under control. And many of the costs are actually outside their control, whether it's the repairs, interest, etc. So for me, I would not be rushing to invest in the Zillows of the world today at the valuations they've currently got. But there's a lot of money going in them betting for the long term about what this could be. But I do believe that of all the things that you could do as a business, probably owning inventory, as these iBuyers are doing, is probably something that I'd be very careful about. And if I was to get into the iBuyer model, I've got a feeling knock and that approach, which is a financing model, is a safer bet. It's not a simple bet, it's not a slam dunk. It's all about interest rates and making a margin on the interest rates with some risk that you have to take on property at the end of the day. So that's the presentation about whether I think it's a future or a fad, and my guess it's probably a little bit on the fad side at this point in time. Now, we can do some questions. I've got a few minutes because I get to control this. Okay. So wait a second. So was that useful, interesting? Yes? Okay. So let me just bring this up. Sorry, I have to multitask here. Can we bring up Slido? Where's the log? Here we go. Here we go. Fantastic. Is there any real technology disruption in Zillow's iBuyer model? Deep learning, AI? Any buyer examples who are not merely replicating the offline model? Is there real technology? I think it's about how good your AVM model is, but I've got a feeling that's sort of becoming a commodity nowadays, especially in something like the US, where you have the underlying data you need is quite accessible. So no, in that respect. I think there's probably a lot of internal systems and processes that allow them to hopefully run more optimized models or optimized systems and processes internally. But beyond that, I think it's just I don't think there's any amazing technology-driven things that are occurring internally. They're still generating their leads to sell the properties off their own website, for example, in Zillow's case, or they're leveraging traditional models. So I'll say there's nothing unique around that. As far as I can see, remember I don't work for Zillow, so I'm just going to give you an outside-in perspective. iBuyer being a great seller lead generation for traditional portal model, isn't it? Yes, it can be a lead generation because remember, if 100 people apply to sell their house and I make an offer on 3, there are 97 people who want to sell their house. That is a lead opportunity to then sell to agents. So yes, that is an opportunity, but what we've identified is that the fact that they're going through an iBuyer means that they want to do something fast for some reason. The question is, how valuable are those leads going to be for a real agent? I don't know. And there's no transparency into Zillow to see how that part of the business is faring. A couple more questions. Here we go. Wait a second, I can get rid of that one. I'll get rid of that one. Right. So what do you think is the competitive moat, IP for iBuyers, to a seller? Do I always just go to the iBuyer that quotes me the best price? Well, at the end of the day, if you're selling to someone, I would go to the person who's going to give you the best price, right? Once you've sold the property, do you care? Right? It's gone. But I've got a feeling that you'll find over time that they'll all asymptote to the one point, right? Everyone's going to basically come back, might be 317,000, one will give you 317.5, and one might give you 318. You're not going to get suddenly 400. So you're not going to get something out of the ballpark for it. So I think the answer is it's going to be very hard to have some sort of competitive moat, except for scale. Brand and scale are about the two things I can think of. Just so large that you get to dominate industry. Now, offline property flippers never took more than approximately 5% of market share. Do you see any reason why iBuyers, the online version, could take more? No. No, because I think they run out of money, right? Because you have to churn so fast. And I think enough money comes in that there's so much competition that the margins get eaten away and eventually investors get tired of putting money in, or the people loaning them money, the Goldman Sachs of the world, just don't get they feel like they're not getting the best return possible. I'm not sure, but I can't see why it's going to suddenly become 30% of a market. Plus also, you have to understand, the psychology of people is if you've been brought up and for the last who knows, from birth to understand that this is the way the real estate market works, it's very hard to then quickly jump into a new model. So there's also a timing issue here about longevity, about whether it will work. And put these up. Two more questions because the next speaker is up. One analyst said iBuyers is not a hard business to start. All you need is capital. I agree. I think it helps. Without capital, you can't start. Let's put it the other way, right? Yes, you need a good AVM model. Yes, you need to have teams on the ground. Yes, you need to be able to select the right markets to go into and so on. But if you're selecting a market to go into, you're pretty much going to look what everyone else has done because they've already done the work, if you're in the US. And I think the challenge in other markets is and as was alluded before by what Malcolm was talking about, is the access to information and all the fact that many of the properties are very different. I think the guys who are doing iBuyer models in Brazil are brave, right? Because there's just not a lot of great information to get good valuations happening. If you look at Loft, they're doing something interesting. They're targeting top-end properties, ones that they know they can buy, invest 20,000, 30,000, 40,000 in renovation, but get a 60 to 70,000 return on it. So they're very much targeting that top end where there is far more flexibility, and they're in the more expensive markets within Brazil in particular, and Sao Paulo in even more particular. And even then, they've only bought and sold maybe 1,000 properties in 3 years. So it's not like they're suddenly going at a million mile an hour. Should portals work with agents on iBuy or do direct only? Pros and cons. I think the answer is what's going to work for you. So if you're doing an iBuyer model and you need to sell the property, share your commission to sell the property. If someone's got a buyer, what's more important is to move the stock than to hold on the stock and have to sell it yourself. And that's that fluidity of moving capital that I think is very important in making that work. We're going to talk more about this tomorrow. Actually, we're going to talk more about it this afternoon when we have a panel with both Malcolm and Georg. So feel free to ask more of these questions because I've got a bucket load here and I can't get through them. And secondly, tomorrow morning we do a roundtable. I'm very happy at the roundtable to talk more about iBuyer model or anything else. I'm no guru on it. I just did a bit of analysis on it and I found it very, very interesting. So thank you very much, everyone. I hope you enjoyed that session. Does that make sense? Okay, thank you.